Hi there, and welcome from Palm Beach, Florida. My name's Alex Rosens, the editor of Bankruptcy and Restructuring Newsletter for Bloomberg Briefs. With me today is Paul Harner, partner at Latham and Watkins, LLP. Paul, welcome.
Thanks for having me.
I guess the first question is, what's the future of Chapter 11s? It's been pretty quiet. There's not a lot of big filings. What do you think happens now? Are we doing all of our work out of court?
I don't think any of us have a crystal ball, and I've been doing this for 26 years now, and if I knew what was going to happen from year to year, I probably would have quit practicing law and started investing money. But we're clearly in a much different environment than we were when I started doing this in 1988, and a much different environment than we were after the financial crisis in 08-09, and a much different environment than we were a year or two ago. You know, I think there's a lot of people who are tempted to say that Chapter 11 is dead, and I don't think that's correct. But I think the nature of the cases that have been filed clearly has changed. The mega cases are much fewer and further between. The cases are much smaller, and they're also much faster. That's not news to anybody, but there are very, very few constituencies, creditor constituencies, or even equity holders who have an appetite for very lengthy and protracted Chapter 11s for a number of reasons. One, it tends to deplete value in a lot of circumstances. It obviously is very, very expensive. And I think the 2 and 3 and 4 year cases that used to happen 15 or 20 years ago are largely over. Every once in a while, especially if there's a precipitating event like Lehman Brothers, you might see a long case like that. But even a case like we were talking about on the panel earlier today, the American Airlines case, probably went much more quickly and much more smoothly than it would have if it had been filed 5 or 10 years ago, because people just don't have the appetite for the long cases anymore.
That change in risk appetite, what's behind that? Is that because of our Lehman case and that one terrifying week where we saw and lost so many businesses in financial services sector, and that has kind of spooked a generation of bankruptcy practitioners?
I think there's an element of that, but Alex, I think it's actually more fundamental than that. To my mind, it's in part, or in large part, because the nature, excuse me, of the investor has changed so radically from 5 or 10 years ago. The large cases, even that recently, used to be driven by very traditional constituencies, banks, trade creditors in the retail cases, for example, funded debt investors who tended to be public bondholders as opposed to hedge funds or other private investors. Now the constituencies tend to be very sophisticated, distressed investors, the topic of this conference, who know the process well, are not neophytes, know how to make it work quickly, and know how, from their own perspectives as distressed investors, to extract value and to do so without a lot of value depleting delay. So I think the nature of the players in the process is driving the change in what the cases look like more than anything else.
And thus we see more pre-negotiated or pre-packaged bankruptcies.
That's right. I don't think, and there have been statistical studies on this, that there's been a marked increase in true pre-packaged bankruptcies that are pre-solicited and you're in and out in 25 or 30 or 35 days. But there clearly has been a marked increase in the number of pre-negotiated cases, which, let's say, end up being 90-day cases instead of 6-month or year-long or 2-year-long cases. That's particularly true, for example, in retail. The model, 25 years ago in retail used to be you knew that you were in Chapter 11 if you were to file for at least 2 years, because you were going to go through 2 Christmas seasons, develop a business plan based on what you saw in terms of store performance, so on and so forth. Now, nobody has the patience for that, first of all. Second of all, there have been changes to the bankruptcy code, most notably in 2005, that make that almost impossible to do in a lot of cases.
The real estate aspect.
The real estate aspects of it, because you just don't have forever and a day to evaluate your real estate portfolio. There's a very sharp limit under the bankruptcy code now on the time within which you can assume or reject leases. But again, that dynamic is only a minor part of what's happened here. What's happened here is that the investors are much more sophisticated, they're much more bankruptcy savvy, and they're much more interested in using bankruptcy as a quick in and out tool to implement a deal that was cut before the bankruptcy was ever filed. So that's why pre-negotiated really has become the model.
Interesting. And when it comes to, let's say, which industries could be under duress in coming 12 to 18 months, do you have any idea, any thoughts as to where we could see some activity?
Well, again, if I had a crystal ball on that, I'd quit practicing law.
Okay.
But there's obviously some conventional wisdom that we will see some things develop in retail. I think primarily just because the world is changing, brick and mortar is not the model any longer. Everybody shops on the internet, but that's not a phenomenon that is a surprise to anybody. We're seeing some things happen in the restaurant industry. The two major waves, one of which people talk about a lot and one of which less, are municipalities. Obviously Detroit has consumed a lot of professional time and is a major problem to solve.
Right.
And it's going to take some more time to solve. And second, healthcare, and I want to be clear that the reason I say healthcare is problematic is not because of all of the political controversy about Obamacare and so on and so forth, but
right.
because there are systemic problems that have arisen primarily because of decreases government imposed in Medicare and Medicaid reimbursement rates that make things very difficult, certainly for physician practice groups and for hospitals, but interestingly for third-party providers.
Well, we saw an ambulance provider last summer that filed.
Absolutely. Another example is last year I represented a regional radiation oncology provider, basically radiation treatment centers that are referred from physicians, and that was a specialty provider. And their business model and their balance sheet had been based on Medicare reimbursement rates of X. Right. And over the course of a few years, it became X minus Y and couldn't sustain the balance sheet and had to be restructured. So I think you're going to see a lot more of that kind of thing. Now, those are going to be smaller cases. Those aren't going to be mega cases, right. But they're going to be very high volume, I think.
When we look at assets and liabilities for those cases, what are we looking at, 100 to 500 million range?
I think so.
Okay.
The one that I just mentioned had total balance sheet capitalization pre-petition of about $500 million. That was probably a little large for what we're going to see. I think
right.
You're going to see a lot of cases in the range that you're talking about, somewhere in the, the smaller cases, 10, 50, 100. What in that space would be considered a larger case is probably $300, $400, $500 million. None of these are going to be 9-figure cases.
Sure.
Right.
Sure.
I'm sorry, 10-figure cases.
10 figures.
Right.
Well, thank you very much for your time, and thanks for joining us.
Thanks for having me.
Take care.
Okay. Be
Thank
well.
you.
Thanks.